Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today, we've got Joel Moffat from Below Market. Now, Joel's background is as a residential property valuer, and I believe that gives some great skill sets that help buyers agents to understand market value and, of course, buy below market, which is the name of Joel's business. We chat to him about his experience working in valuation, how we as investors can get the best result, making sure the valuations stack at the beginning, and when we're redrawing or revaluing our portfolio for equity, we can get better results. He shares some insights in the difference between the full inspection vals and the desktop valuations. And of course, we unpack what buying below market actually means. Is it buyer's agent spin, or is it a real thing that we can achieve even in hot markets? Joel shares some insights also into the way that he believes property should be fit to the strategy rather than the property and the deal coming first. He also shares generously his secret herbs and spices into the locations that tick all the boxes for him as an investment location, and shares some of the areas that he's transacting in as well. An awesome interview with Joel, and I'm sure there's going to be something in it for you. Here's Joel. Joel Moffat, thanks for joining me on Geared for Growth.
Mike, thanks for having me. Really excited.
I'm always excited when I get a fellow analytical person on the show. And as evidence of that, it's your past vocation where you were a valuer. So you've been working inside that bank valuation engine room. And I want to know from the inside how those valuation panels or the internal valuations work when it comes to property, and what you've learned that's given you some secret insights that you can apply to your clients and your own investing.
Yeah, for sure. So it's a good point you raise. You know, every valuation space operates differently, because I was one of the big four, and actually the only big four that have internal valuers. It was an interesting insight into how they operate, and you know, one of the biggest pros to the work, I guess, the valuations that they turn out was the turnaround time. Given that, you know, the internal valuation team was able to, you know, knock out especially desktop valuations within 4 hours. So just seeing the speed and the quick return on those valuations and how that impacted our clients. It was an interesting intel. Obviously, everything else in terms of the valuation space is purely from a panel perspective, so it's outsourced. And as you're aware, you know, there's a bit of a lag time there. So that was certainly the value add from the employer at the time. But some great insights having worked with them over a few years, and just really building on our foundation of the business now, which is property valuation.
I'm interested in what the banks are most worried about. I mean, I suppose it seems obvious they're lending money for something that's worth less than the agreed amount they've lent it for. Of course, they've got that baked in kind of risk mitigation with the loan to value ratio, presumably not being 100% or higher. But where's the bank's head at when they're looking at these vals? Is it purely about protection, or is it a box ticking thing, or how do they actually view their own valuations? I mean, obviously with the place that you worked for, having an internal valuation team gave them some sort of competitive advantage or some risk mitigation that made them want to go to that expense, right?
For sure, definitely. And I think you raise a good point, but it was purely risk. I mean, that's where their head's at, and it always is as part of the valuation space. You're right, the loan to value ratio is where it all comes in into the equation. But even so much as, you know, the risk analysis that we perform, it wasn't just a numbers thing. Obviously, that was the foundation of the risk, was where the value sits. But obviously, as part of the market analysis and the risk analysis, we looked at, you know, the overlays and everything that can contribute to the risk associated with the subject. So things like your bushfire, your flood, your heritage, your proximity to transmission lines, you know, main vehicle access and the like. there was that component of risk as well, Mike.
Was there a flavour of the month with the bank? I mean, are they looking a bit more closely at those uninsurable type properties for risks like flood or bushfire, or is there any sort of standouts that you can
So
remember?
it's so interesting because we never really got to see the back end. After you flag the risk, you don't really get involved. So it goes
Right.
back to the broker, and there's obviously a formula there that they take into consideration with each particular risk. But I did note that, and just due from feedback with the internal bankers and brokers, that pending the particular risk, it can certainly impact the loan ability to the client.
Mm. Let's talk about, I suppose, advice for people that find themselves in the vicinity of a valuer. What have you sort of seen that helps a property valuation go smoothly, or conversely, some of the red flags or friction points that can slow it down or lead to a negative income? Because I suppose from an investor point of view, we're talking about, okay, we want the valuation to stack up on this new investment, but if we're revaluing our portfolio, we want the valuer to make a mistake and overvalue it by about 8,000%.
Mm-hmm.
So what's your best advice for those two situations in getting the outcomes we desire?
Yeah, it's a good question because the outcome that everyone desires is just the best market value to the subject, right, and the highest possible at that. I saw that with the desktop space, so there's long form and short form, obviously, and that's a space that's really starting to take off. And I was part of the desktop team before I left that they were releasing to sort of increase their ability to take on desktops and short forms, and as a result, their insurances increased to sort of cover their risk there. But I think that's where the most opportunity lied for a lot of property owners, because there is the ability to. In saying that, though, it's also where the most risk lies. If it's, say, a renovated subject, and it doesn't show up on recent imagery, that can negatively impact. But I
Mm.
think the majority of the impact was purely positive, based on the fact that you could get market value maybe slightly higher than you would on a long form approach, where you need a physical inspection, purely based on just some of the comparables that could be used with desktops. I think whilst they use the same comparables, both long form and short form being desktop in this scenario, I think desktops really sort of took on some stronger comparables for whatever reason. I think that was usually the case. So, if you can get a desktop, I certainly see it as being a positive thing.
And typically, would a desktop only be granted if the LVR was under a
Mm.
certain amount, or are they considered like safe suburbs or safe locations that the bank sort of leans on the desktop method a
No,
bit more?
you're right. My understanding is it was purely based upon the LVR, as opposed to the location. So if you've got a healthy LVR, say 50, 60, 70%, I'm not sure of the exact figures, but
Yep.
you'd fall into the category of a safe um, client. And then as a result, you would get I guess, a less risky approach to the valuation, being a desktop.
Yep. That makes sense. So with desktop valuations, they're obviously faster and cheaper. And we've talked about some of the ways that they can be advantageous, but where can things go wrong and what are the limitations of those? And are there times where maybe we're looking at a property or we're trying to revalue and we've got a desktop, but we're unhappy with the outcome? I
Mm.
mean, is it likely that a full inspection is going to give a fundamentally different result?
On the back of a desktop that's been sort of flagged below market value in the owner's mind, I think for sure there's the ability to query on the broker's behalf or the banker's behalf, which is as simple as clicking a button and providing a bit more info as to why the query needs to be attended. And in that scenario, it's certainly worth an on-ground approach, because there are features and components to a property that could be missed on a desktop. I was just mentioning before with outdated imagery, for example. Um, so in that case, yeah, definitely, and it's quite common, Mike. To be honest, that pushback, especially after an initial desktop.
What has this training sort of given to you now that you're sort of transacting as a buyer's agent? Is there something that you can point at that just sort of says, look, I wouldn't have the confidence to be going in and purchasing these types of properties without that background? Or is it just more of an understanding about how the whole machine works? Like, what would you point to say that the biggest sort of benefit is with that background to what you do today?
I think two things. One, getting a real understanding for the risks involved, and the risk analysis side of things. But fundamentally, it's understanding market value. That has just been, the foundation of below market and where we're heading and where we'll continue to go. Just having that understanding of market value via a direct comparison approach, that's being able to really benefit our clientele. Just being able to purchase obviously below market, but just understanding that market value more than anything.
Yep. Let's talk about below market, because I think the property industry is famous for all sorts of different sayings and catchphrases. And of course, it's baked into your business. Like, to give you an example, there'll be buyers agents that talk about, we only buy off market, or 90% of our transactions are off market. Like, that fundamentally is a positive or a negative thing. I think there's a number of different ways you can spin it. But what does below market actually mean to you? And how do you achieve below market when you're negotiating in especially competitive areas? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, so the API defines market value as a willing transaction between a willing buyer and seller at market value at an arm's length transaction. So understanding the definition, I guess, in the first instance. But for us, it's a matter of strategy. So purchasing below market obviously takes two real components in my mind, and that's your relationship with the agent, as well as the negotiation component of the transaction. So having both of those up our sleeve, I guess, going into a purchase is how we are able to purchase below market. But below market is a great name, and it's part of the the foundation of our business and our model. But it's not the only sort of component to our strengths. I think and I was using this scenario with a client yesterday on a call. It's great to purchase below market, but let's take an example of $1 million purchase. If say we save 20, 30K in terms of market value, that's fantastic, but it all comes down to location, essentially, because that's the main driver of capital growth, as we know. And say 10% per annum versus a poorer location that might do 5%, there's a $50,000 difference per annum, even without considering, compounding growth and how that actually works year on year. And, that's increasing. It's not just 50,000 each year on year, that's increasing. So, I sidetracked a bit here, but that's exactly, I guess, where the real value add is for our clients is the choice of location. It's not just down to purchasing below market, because at the end of the day, that's only great initially. You get that uplift and you can get that initial equity, but that's fantastic. For us, it's about ticking a few boxes along the way. Initially getting that instant equity, purchasing below market, but then the ongoing, I guess, the line in the sand after you purchase will purely all come down to your location. So that's more important for us for sure.
It's a good point, because you could buy below market in a market that doesn't do anything for 10 years. And it's like, well, yay, I got like free stamp duty or something. It's not actually a benefit. And I think one thing that you need to know to be able to buy below market is the actual market value, right? And who better than someone that has a valuation background?
Yeah, that's our selling point for sure. I mean, there's a lot of buyers agencies out there that say they understand market value, but at the end of the day, we're a certified valuation firm with the API. We've gone through the training, and that's the foundation of my previous experience. So, yeah, what better way to understand market value? Exactly.
I want to ask you about something that you kind of introduced to me as a bit of a concept, and that was tactical buying. Now, I suppose if you're buying below market, it sort of dictates that there are some tactics at play. As much as you're willing to share your secret herbs and spices, what are we talking about when we talk about tactical buying, and what sort of methods do you employ to achieve the best outcomes for your clients?
Yeah, so in terms of strategy, you raise a good point, but it's not so much a secret approach. It's generally been pretty transparent, and the sales agent on the other side can vouch to this sort of strategy. And the majority of the time agree that the majority of our strategy lies in understanding market value and just being strong with our initial offer. That's what a lot of it comes down to, because at the end of the day, it's a momentum game, and good deals get done quick. That's part of our motto. So we don't stuff around. It's a matter of understanding market value and offering a strong offer to start. It is below what we see as market value, but at the end of the day, and a sales agent on the other side can probably attest to this as well, is that it they're making their money based on a percentage, right? Usually between 2 and 4% at a high level. So 20K for our client is as little as a few hundred for them in their pocket. So it's another interesting point that we use to our advantage.
That is a funny thing, isn't it? When you look at the real estate sales contract, such as it is, unless it's been, I suppose, doctored to have upside commission potential for over a certain point, there isn't a huge incentive, purely a fiscal incentive, for the agent to potentially jeopardize an existing price to try and push that extra bit further. Now, I'm sure there's lots of sales agents that are listening that are thinking horrible things about me, but I'm purely just talking about the financial kind of drive. It doesn't actually exist there. And is that something that you feel like a buyer's agent can take advantage of?
I do, and I think that's what we do. But in saying that, a good sales agent is representing their client, and at the end of the day, they may understand as well. The other side to the story is that extra 20K they might not get. There's a question mark there, right? There's uncertainty, even though they may understand market value as well as us, which I'm going to say they don't. But if they do, then there's still that uncertainty there. So for them, it's a risk to push back, on that, say, sub 20, sub 30K offer, because they don't know if that offer they're chasing is there for their client. Plus, they're aware that time is money, so it might be there, but it might be in another month or two's time. And at the end of the day, is that really worth chasing?
I'm interested in the sort of time is money context when you're talking to the selling agent, and you made the point of saying, we'll put in a strong offer, because any idiot can offer 400K for an $800,000 house, right? But that's more likely to annoy the agent. So where do you kind of strike that balance to say, look, we are trying to buy below market, but we're not trying to throw something out there that is absolutely ridiculous and puts both the agent and the vendor on side and puts me in a box as a nuisance?
For sure, I think it's a balance, but I think it's a matter of justifying our fee to our client, right? So if we can charge our client a certain amount and save that in double, it's a good balancing act. That's the way I see it. It becomes a win-win scenario, which is what we're always trying to create for our clients, and for us, because at the end of the day, we're operating a business, and we're trying to save our clients money, and we're trying to make money. So it's a balancing act. You're right. You don't want to get too far beyond. It's very rare that we sort of exceed that 50K mark unless we're getting above that $1 million mark, generally speaking.
It's an interesting point when you think about the opportunities to I suppose use your tradecraft to the benefit of the client. There's not just the way in, but you're talking about, okay, well, let's maybe satisfy that that one track mind that a client might have is that I paid you X, and if you can get X plus anything off the purchase price, well, that was a good decision. But there's more to it, right? There's the due diligence, there's the location itself. And like, just imagine thinking that the location is just a free upside of why you work with a buyer's agent. I'm a big advocate for good quality buyer's agents. And there's a number of different ways you can actually generate value to the client over and above buying under market, right?
You're right. Yeah. It's not just, the market value side of things. It's a location, it's a due diligence, it's a strategy. There's so many components to our service, and it's everything from strategy to settlement. So, we've got a 14-step process, and each of those steps we can add value for our clients. So, it's not just about the one or two, components, whether it's, market value or location. They're obviously the main ones, but there's certainly opportunity to value add on every step of the process.
Let's take a minute to investigate those two issues, the strategy and the market, right, as additional ways that a buyer's agent can add value. When it comes to strategy, I feel like that's probably the most underdone part of a property investor's journey. Often they'll decide to invest in property because they intuitively know that it's good for their financial future, but they're not necessarily got a perfect plan to say, I want to retire on X, or I need enough money to do Y, so let's backfill the strategy for that. And I know you're a big believer in fitting the property to the goals of the client. How would you rate the level of sort of sophistication of clients coming to you in and around strategy, and how do you work with them on that?
Yeah, great. So look, it's a matter of reverse engineering it, and you're right. You touch on whether a client comes forward and says, we want X amount per year upon retirement. That's a very common one. Or if they say they've got the goal of an owner occupier, that's probably the most common one that we have in time, but they can't afford it now, so they take on the rent vesting model, which we proactively push. But regardless of the approach, it's always a matter of reverse engineering. That's where we find the most success for our clients, for sure. You're right as well. We I guess we're a little bit different to a lot of the big BAs in the space, and this isn't a bad mouthing rant by any means, but a lot of the big BAs have built machines where they have to source their properties before their clients, essentially, and that's I've seen it firsthand using them. That's exactly what they do. They source their properties, and then once they sign up a client, they match the property to the client. The issue I have with that, and that we have as a business, is that it's not a one size shoe fits all approach, right? For us, every client has different goals. Every client has different serviceability. So it's always a matter of our clients come to us, and then we source a location post engagement. Just because every location offers a different strategy as well. So it's a matter of matching up the right location with our client. It's pretty common to go to one of these big BAs and they'll say, thanks for signing on. Here's Townsville that we're pumping at the moment, or whatever it might be. Perth, take any example. It's a common approach, and I'm not bad mouthing it because we might be there at some point. But the bigger you get, you need to build a machine, and I just don't see that as being the most ethical or efficient way to gain growth for our clients.
I remember the first time I saw almost like a menu of property investments, where there would be an email newsletter to say, look, off-market opportunity, here's a little bit about it, get in touch to offer it. And it certainly is a really different approach. And I get what you're saying with some of the big BAs. It sort of feels like, okay, you hit the green button on the conveyor belt and here comes your property. It'll take a little while because there's a few people in front of you, but here it is, the one deal that lands in your pocket. Now, is that designed for you, or is it just a series of properties on the conveyor belt that meet their metrics or guidelines and those sorts of things? I mean, Can there be a universally good investment property for an individual? I'm really trying to lean into this devil's advocate sort of thing. Like, if there is a great property that we know is going to do, or say no, but we suspect is going to do 20 or 30% growth, like, is that good for anybody?
And that's a great point you raise, because at the end of the day, if it's got strong capital growth perspective, it's just a matter of targeting that for almost any client, because everyone wants capital growth. That's what everyone's chasing. Sure, it's a balancing act. It's a weighted scale. It's cash flow on one side and capital growth on the other. So if one goes up, the other generally goes down. But at the end of the day, everyone's chasing capital growth. So I think, some of our locations, and there's a couple that come to mind, are very big on short-term capital growth at this point in time. And that would be a location almost to anyone. But there is also, it's worth considering that the more skin you've got in the game, the better. So if a client comes to us and says, hey, we've got $1 million to spend, a couple of these locations that are really strong in capital growth for us at this point in time are actually around that sort of 650, 700K mark. You're almost better off targeting something at the full capacity of $1 million, which, they might have in serviceability, because you might take a slightly lesser hit on the capital growth side of things, but you've got more skin in the game. So you end up slightly better ahead, if that makes sense, Mike.
Yeah, I suppose with the power of leverage, if you're getting, let's say, 0.25% less growth, but you've got exposure to a more valuable asset, then the numbers can actually work in your favour. Is that what you're saying?
Yeah, exactly.
Now, you've mentioned locations a couple of times, and it'd be remiss of me not to sort of picture the listener going, all right, Mike, just get on with this and ask this bloke where he's buying. You may or may not want to answer that. I'll leave that up to you. But if we are just talking generically about areas and locations, what do you look for in a growth market? Are there certain boxes that you like to see ticked?
Yeah, no, it's a good question. And it's a question that it always used to frustrate me listening to podcasts, and hearing other buyers agents just have such a closed book with their locations. I'm pretty transparent, to be honest. It's a funny thing, because we've got locations, and look, predominantly speaking, the majority are on the east coast of Australia. We target Victoria, New South Wales, and Queensland predominantly, and they're major hubs. We're not chasing hotspots that you haven't heard of, essentially. But it's a balancing act for us to sort of get on the outskirts of these locations at a macro level, because we've seen a niche for that balance of cash flow and capital growth. There's so many BAs that just target one or the other. They're very pro cash flow or they're very pro capital growth. For us, it's very much a balancing act. So as a result, a lot of our locations are on these outer rings of, your Newcastles, Sydney's, Melbourne's, Brisbane's, that you've heard of. Sure, we've got some regional markets that are more affordable, that may be further up or down on the eastern seaboard, but it's certainly they're not locations that you've never heard of, put it that way.
And what's the big driver for you in being sort of in and around the bigger established markets? Is it about the employment opportunities and the diversity of the economy, or is there a population sort of secret point where it gets to over 50,000, 100,000, you feel more comfortable? What is it exactly that makes those attractive markets?
It's purely population and infrastructure in my mind. And that's what the advantage to purchasing in one of these sort of major hubs is. That's what they've got to offer. The other side of it is that, these other locations at a more regional aspect are very much, up and comers in that regard. So they might not have that yet, but they've got it in the pipeline, and that's, government committed. We're not just pulling it out of a hat. That, we're choosing these locations on evidence of, that government spending, for example.
Yeah, and the government has been spending like crazy, well, pretty much since COVID, so there's plenty of projects going on. I mean, you could point to any state in Australia and there's a fair bit of investment going on. Kind of leads me to a final question. 2025, obviously investors have seen the rise of places like Perth. That's kind of lit up all the forums of like, where's the next Perth? I'm just wondering, are we getting a little bit lost in these sugar hit kind of hot spots and should be considering investing in the long term? Or is this just a fundamental shift where we realize that, okay, to make money in property quickly or grow a portfolio, we do really need these markets that are doing 10, 20, 30% to achieve those goals? Where do you land on it? And what do you think an investor needs to know navigating investing in 2025?
I think the investor needs to prioritize their own goals, right? So at the end of the day, everyone's got different goals, and as a result, the location's going to differ dramatically. I think if you can, property is a long term game. Property investing isn't a short term game. Although a lot of people are chasing that, that's where you really benefit from the snowball effect of compounding growth that we touched on earlier. And I think that needs to be considered. At the end of the day, if you've got the ability, it's a long term game. In saying that, if you've got a serviceability and you've got the appetite for short term growth, there's still locations to match. And that's what we chase. But it just depends on the client. We're not going to push our location first. We're all ears to start, because at the end of the day, we match our locations with our clients.
I love that. And I think matching the property and the location to the goals of the client is something that we should be talking a little bit about more. So thank you for sharing your wisdom on that, Joel. It's been a great interview with you today, and thanks for jumping on board.
Mike, I really appreciate it. Thanks again.
Cheers, mate.
See ya.